This is TechCrunch.
The bidding war for Warner Bros. Discovery and its extensive library of hit TV shows and films is dragging on. The studio on Wednesday said its board had unanimously rejected Paramount Skydance's revised $108 billion bid, calling the proposal a leveraged buyout that would encumber the company with $87 billion in debt. In a letter to shareholders, Warner Bros. Discovery urged them to reject the offer, saying the extraordinary amount of debt Paramount would need to raise heightens the risk of the deal falling through, and instead recommended they vote in favor of its earlier $82.7 billion deal with Netflix for its film and TV studio assets. Paramount, which was rumored to be in the running to buy Warner Bros. Discovery before the Netflix deal was announced, went directly to Warner Bros. Discovery shareholders with an all-cash $30 per share offer in early December after Warner Bros. Board decided to sell to Netflix. But Warner Bros. Discovery rejected Paramount's bid, calling the offer illusory, and saying Paramount did not have the cash to back up its claims, and instead recommended Netflix's cash and share deal. Paramount then came back with a $40 billion guarantee from its CEO, David Ellison's billionaire dad, Oracle co-founder Larry Ellison, and said it would raise $54 billion in debt to fund the deal. Warner Bros. Discovery doesn't seem convinced. In a statement, the company wrote, "Paramount is a company with a $14 billion market capitalization, attempting an acquisition requiring $94.6 billion of debt and equity financing, nearly 7 times its total market capitalization. This aggressive transaction structure poses materially more risk for Warner Bros. Discovery and its shareholders when compared to the conventional structure of the Netflix merger." Warner Bros. Also called into question Paramount's ability to function well if the deal goes through, arguing that raising such amounts of debt would further worsen Paramount's current junk credit rating. Warner Bros. Was particularly concerned about Paramount's negative free cash flow, which would be exacerbated by any acquisition. The company said, in contrast, Netflix is a company with a market capitalization of approximately $400 billion, an investment-grade balance sheet, an estimated free cash flow of more than $12 billion for 2026. Netflix welcomed Warner Bros. Discovery's decision, saying after the merger, the companies would bring together highly complementary strengths and a shared passion for storytelling. At CES this week, tech companies are unveiling the latest wearable health devices: glucose monitors, blood pressure trackers, fitness trackers. Probably not mentioned at the show is that these gadgets might be creating a massive environmental problem. It isn't something that tends to get much attention, but a new study from Cornell University and the University of Chicago found that by 2050, demand for health wearables could hit 2 billion units per year, or 42 times more than today. Unless we change how they're made, the authors of the study warned these devices could generate over 1 million tons of electronic waste and 100 million tons of carbon dioxide over that same period. An even bigger surprise is that it's not the plastic that's the problem. The study published in Nature found that the printed circuit board, the device's brain, accounts for 70% of its carbon footprint, largely due to intensive mining and manufacturing. The researchers suggest 2 fixes: develop chips using common metals like copper instead of rare minerals like gold, and make devices modular so the circuit board can be reused while the outer covering gets replaced. When these devices are deployed at global scale, small design choices add up quickly. It's something to think about while scrolling through CES announcements. That's it from TechCrunch. For more stories like these, go to TechCrunch.com.